Good morning, everybody, and welcome to our webinar here on the Michigan Flow-Through Entity Tax, a new tax that was just passed by the state of Michigan right before Christmas. My name is Matthew Latham. I am a tax partner here at Maner Costerisan with over 15 years of experience working with mostly small and mid-sized businesses on various multi-state issues in the construction manufacturing industry, as well as our affordable housing niche. I'm excited to be here to go over this tax. The interesting part is that we were hoping for the first time, I guess, in a little while that we wouldn't have any tax law changes. And at least for now, the federal government came through for us, but the state of Michigan kind of threw a curveball in the dirt right before Christmas that I know left a lot of taxpayers and practitioners scrambling right at the end of the year. The good news, at least, is that you're not late to the party if you haven't done anything with this yet. At least there's still an opportunity to work through it. Depending on your method of accounting, though, the benefit might end up getting delayed. So I guess first, I just wanted to start and talk about the history of Michigan Public Act 135, which is the flow-through entity tax. It got signed into law December 20th. The law made it retroactive to the beginning of January 1st, 2021. And we will kind of go over the cash basis, accrual basis issues that exist. But what this did immediately create was a compliance issues for taxpayers and professionals alike. This is actually the third time that this law had been passed by the legislature. Governor Snyder vetoed it once. Governor Whitmer also vetoed it once as well. But then the legislature worked through some of the issues that existed for trying to implement the tax, that they were able to get this through. This all started back with the Tax Cuts and Jobs Act of 2017 that limited the state and local tax deduction at the individual level. Basically what this created is that, especially for high tax states that we saw mostly on the coast, like in New York and California, that individuals between the property taxes and income taxes certainly had paid in more than $10,000 for the year, so they couldn't get anything on top of that. The high tax states in California and New York tried to get creative with it at first. I think at one point California set up a charitable trust. So they tried to create a charitable tax deduction, but the IRS came in and said, no, this what you're really doing is you're not donating to a charity, you're paying your state taxes to the state, and we're not going to count that as charitable contribution. So the states then kind of went to the next step and said that we're going to create basically a business tax expense that will allow business owners to deduct it as a business tax expense on their federal return, which at least at a minimum helps on the federal side. And the IRS has given notice that they are okay with this method. So currently there are over 20 states that have this workaround. Connecticut happened to be the first. Michigan, at least for now, is the latest. And I know, there's going to be more as time progresses, as long as the state and local tax cap exists. If you happen to have multi-state issues, which we'll get into a little bit, do understand that every state might be a little bit different, though, I believe that essentially the core concept remains the same. First, starting off with eligible entities. Basically, this can boil down to, for the most part, partnerships and S corps. If you have an LLC that you've elected to be treated like a partnership or filed as a partnership, then you will qualify. All forms of partnerships, except for publicly traded partnerships, will qualify, and then S corps will fully qualify as well. Entities that do not qualify for the tax, basically, like I said, publicly traded partnerships, flow-through entities that are subject to the financial institutions tax. Disregarded entities, or your Schedule C's, Schedule E's, do not qualify. And then obviously if an LLC has been taxed as a C Corp, you're not considered a pass-through. So LLCs that are elected to be treated as a C Corp don't qualify, as well as just your standard C corporations. The immediate issue that happened was basically how do I elect, how do I handle, actually get into this tax so then our business can pay it. Basically, the state of Michigan is saying that you have to submit electronic payment to the Treasury Department through the Michigan Treasury online website. And we have a short URL there for you to go to. The website was not fully set up at the end of the year. So what they did was a fast track option. So that opened up on December 29th. So that allowed cash basis taxpayers basically 3 days to get a payment in. And if they did, they were good. For your 2022 tax year, if you decide not to elect in 2021, you have to make the election by the 15th day of the third month after your tax, or in that tax year, excuse me. So therefore, for calendar year filers, that means for 2022, your election actually has to be made by March 15th. And to do that, basically you go on the MTO website and you make a payment, an estimated tax payment for your first quarter of 2022. For 2021, the election, you can wait till April 15th of 2022. So that is a difference. Those dates are correct, which obviously creates a unique compliance issue or tax planning issue, especially if you decide that in 2021 it's not worth it. You might be running into a 2022 deadline. For 2021 also, the state has said that you should be paying any unpaid quarterly estimates so that in theory, if you were able to make a payment by January 18th, which was the due date of the fourth quarter payment, what you should have done is paid up to the first 3 quarters and then paid the balance after the fact. Now, if you decide to make this election for 2021, the state would prefer that you pay in 100% of the payment. The state has also said that they won't be penalizing you if you happen to underpay on the first year return. So it might not be a big issue. There could be an interest issue if you decide to make a payment by April 15th, but maybe extend to file later on. The due date of the return is going to be the last day of the third month. So that would be March 31st for 2022. And then there are extensions available, as I'll get into a little bit later. Also, if you make this election, note that you are locked in for 3 years total. So that means if you do it for 21, you have to file this tax in 22 and 23 as well, provided that the SALT limit does not go away. And I also need to note that the SALT limit right now under the federal tax laws is set to expire after 2025, so that if it does not get extended, this tax will effectively go away. This is also a key planning point because in the Build Better Back plan, the Democrats specifically were talking about raising the limit to 80,000. Now, it doesn't seem like that's going to be likely, that's at least for now, that's going to happen. But do understand that that is out there, because it obviously changes the discussion for how much tax might be deductible on an owner's 1040. So to start out, the state basically had to define what the business income tax base was. Note they are not using the phrase taxable income. And if you actually look in the law, they don't use the phrase taxable income. They discuss the business income tax base. I'm going to cheat a little bit and make it a little more generic that basically you are going to start with taxable income that's reported by the pass-through entity. The reason being why the state doesn't use taxable income is, technically speaking, in the federal definition, partnerships and S corps don't have taxable income because it's a pass-through entity. I'm going to tell you basically you can start looking at Schedule K, potentially at your Schedule M1 line 8 with some adjustments. And we've listed some adjustments there. Some of these are in the Individual Income Tax Act that you kind of see on the individual's 1040 to begin with. I'm going to point out that charitable contributions is an adjustment, which if you think about it, since it's not deductible to come down to federal AGI, it kind of makes some logical sense that the state would disallow that deduction, as well as any taxes measured by net income. That includes city and state income taxes that are paid through this act. So that way you don't end up in an infinite loop of always trying to figure out how much tax there is. So basically you're going to start with federal taxable income, adjust for these items if you have it, and then from that number, you're going to add back, you're going to calculate your tax, which then obviously becomes a deduction on the federal return. but then you're going to add it back to end up with back to the same income tax base when you actually file your individual's 1040. Also understand that the tax base that is allocable to only those members subject to this tax is what the tax is calculated on, so that if you have, a partnership that has, or an S corp that has an entity that's not subject to the individual income tax, then that whatever their ownership percentage is going to be actually removed from this calculation. So take that into account. If you deal with tiered structures, tiered partnerships, for an example, you do kind of look through and see who the end user is. And then you can try to figure out which entity that you want to actually have pay the tax. On the tiered structure, for example, if you have a tiered partnership and the initial entity, the first entity, is the one that elects to pay the tax, and then you have some additional activity in the second entity that gets the K1 from the first one, and you want the second entity to pay the tax as well, what you do then is that you actually remove the amount of income that you've already paid tax on to come up with the new number. It might just be simpler to have the second entity pay the entire tax, but cash flow, distributions, there's other factors that need to be taken into account. Plus, obviously, if the first entity is the one that's actually driving the tax number, might not make sense for the second entity to pay the tax, even if it's easier to look at. If in the tiered structure, if the income tax base is negative, no adjustments will occur into the second entity. And then you are still including any positive income from an entity that does not elect to pay the tax on this flow-through entity. If you have losses that come into play at the end, realize that NOLs will not exist for the flow-through entity tax. Basically, your tax will be zero. And then sales factor apportionment exists for this tax as well, very similar to what you see on the 1040 and also what you see on the corporate income tax side. The due dates of the return. Basically, it's the last day of the third month. I'm going to try to focus in on calendar year filers because I know that's where most flow-through entities are. But I do know if you have a non-calendar year or if you have a fiscal year end other than December, do know that it is the last day of the third month. So for 2022, for example, the returns are going to be due March 31st, 2023. Only for 2021 is the state giving you kind of a 2-week automatic extension, I guess I'd call it. However, you can get an actual 6-month extension. The state does accept, or it looks like they are going to accept, the federal extension as an extension. But understand that this is not an extension to pay, that you will still have to pay the tax that is due, that you expect that is due by March 31st for most years. Again, we've already talked about a little bit the election to pay, so that if you decide to pass on 2021, you have till the 15th day of the third month or for March 15th of 2022 to pay the tax. And again, the goal is, or the state at least says, they would like to see you pay 100% of the tax due if you have not already paid this yet. And then from there going forward, you're going to be paying estimates, which fortunately I kind of joke that it wouldn't shock me if the state decided to change the estimate due dates to something different, but fortunately they are following the individual estimate due dates, so April, June, September, and January. And at least as of right now for 2021, there is no underpayment penalty that the state is calculating. Again, logically, because they passed this tax on December 20th. So nobody obviously knew about it till then, that it was actually going to be law. From the federal tax impact side, which again is usually what's driving this decision, from a federal tax impact, there are some deductibility questions that have arisen. And it's good to kind of think this through because obviously this is still a relatively new tax, even for the other states that have implemented it. So the IRS sent a notice out actually in 2020 that's basically a specified income tax payment is one that the flow-through entity makes during a taxable year in computing its taxable income for that year in which a payment is made. That has caused some people to raise a concern that based on that, it doesn't matter what your method of accounting is. That for cash or accrual basis, that the taxable year in which the payment is made is pretty black and white, that if you make obviously the payment now for 2021, that even for an accrual basis taxpayer, that the IRS might not accept that as an expense. I will also tell you, though, that in the Internal Revenue Code, that under Internal Revenue Code Section 164A, they say that a SALT deduction is for the tax year in which the taxes are paid or accrued. So this has caused some differences in opinion, but I do feel that cash basis obviously is pretty straightforward, that it's the year you pay it is the year that you're going to be able to expense it on the federal side. From an accrual basis standpoint, I do believe that there is a pretty evident argument that you can make that as long as the tax was accruable as of December 31st, because that it retroactively applies to 2021, that even if you make the payment in April, you can still accrue it as of 12/31 because you should know what your taxable income is. Therefore, it's a recognizable liability. But like I said, this is just one of those hedging that some people have said that they're not 100% sure that that's what the IRS is going to try to do. And then obviously, you know, what the IRS tries to do versus what is actually real can obviously be different. So in my opinion, I believe that you're going to be able to accrue it kind of like you're able to accrue corporate income tax, you know, by doing a tax accrual. I don't see why this would be different for an accrual basis taxpayer, but at least it is something maybe to have a discussion in case, you know, you happen to be risk adverse. And that I do think it'd be very conservative not to, even on accrual basis, to deduct it, even though, like I said, it applies to 2021. As far as reporting concerns, how is this going to show up? How are you going to know as a taxpayer what you have to report? So each entity is supposed to report it on the federal K-1. The state has actually said that they basically don't care as long as the important information gets reported to the individual. So something like, you know, stating that there's a compliance need for the individual owners or owner, if it's a 100% owned S corp, you're going to have to provide information regarding apportionment, and you're going to have to report their allocable share of the taxes that actually got paid, and they're added back, so that way they can do the adjustment necessary on their individual state return. That also goes for refunds, because the refund won't be taxable at the state level either, and you're going to obviously have to report the share of business income that is being taxed, along with any apportionment information. So again, the state, as far as I can tell, there's not going to be a state K-1, though in theory, if you created a state K-1, that provided all the necessary information, you're good to go. But again, like I said, right now the state basically said, you know, you can do basically what you want. If you want to add a footnote to your federal K-1, great, it works. A statement, great, it works. We don't necessarily care how you report it to the individual shareholders and partners, just as long as you do. As far as forms to file, right now the state is not including any forms to file in the traditional sense of how you normally e-file a tax return with the IRS or with the state of Michigan. They have said that all the return and payment information is going to be filed through an MTO. So in some regards, that's almost like a withholding tax, even though that's not what this is. So as far as we can tell, no forms are going to be filed in the traditional sense. It doesn't mean forms won't exist, because obviously you have to come up with the number. And then the way I envision this happening is that your tax advisor is going to actually prepare the return, prepare the forms, and then potentially the individual business is actually going to have to go online and report the necessary information that actually is on that return. From a tax reporting standpoint, then your federal taxable your federal K-1 is going to show less income because the business is paying the tax. The tax expense is going to be added back on the state return, and then you report it as a credit on your Michigan 1040. So you're still going to report the income on your state return. I know early on, some people were thinking maybe you would reduce your Michigan income tax return by the amount of income that you've already paid tax on. but that is not the case. You're going to get a credit on your personal return. It's going to raise a concern right now, especially for 2021, that I'll get into here in a minute. I know something that we've been discussing with our clients as well. So basically, what this boils down to is that tax planning is a must. Make sure you contact your tax advisor for assistance. This isn't going to be as straightforward as I think a lot of people thought it was going to be. I know if you are a 100% owner of an S corp, that's probably the most straightforward situation you can come to the table with. But even then, there's going to have to be a discussion on exactly how this impacts you. Note that if you're a multi-state entity, obviously your income allocable to Michigan is the only thing that's going to get taxed in Michigan. Also see if the other states have income, similar income tax that you might be able to utilize this for. And also it gets even more complex if you have multiple owners or if you have multi-state owners, meaning that one owner's from Michigan, one's from Ohio, one's from Indiana, from states that don't have this tax. There's going to need to be a discussion on how those states treat this expense. Are you going to actually be able to deduct it? And also note that spreads out the benefit of the expense. Already mentioned the election concern. Just as a reminder, 2022 deadline is actually before the 21 deadline. Keep in mind, though, if you do elect in 21, you don't have to worry about it for 2022, at least to do the election. It's only really for the individuals that might decide to pass in 21 and then want to elect for 2022. Maybe you have a loss in 2021 and your income is just not high enough, but in 2022 you're expecting a big year. Also note that if you don't elect by the prescribed date, at least right now, there's no late relief. Basically, the state has said you're SOL, and at that point you're going to be waiting an extra year before you do this. We'll see if that changes. I'll be surprised because the state's made it pretty clear they're trying to make this as easily, from an administrative standpoint, as easy as they possibly can on their own systems. Also understand that any refunds through this tax are going to likely be taxable because of the federal tax benefit rules that exist on your 2022 return. Again, it's going to be probably a bigger issue for this year or for 2022 because a lot of taxpayers, they paid in estimates over the first 3 quarters of 2021, and then they basically paid it again through the flow-through entity tax. So now they're going to get massive refunds on their individual state returns, which is going to be taxable when they actually get that refund. So realize that is at least that's going to negate the impact or the benefit a little bit. Certainly going to be more of an issue, I think, for 2020, for the 2021 return and the refund that taxpayers are going to get. But also understand that going forward, that is still a thing, even though you haven't necessarily double paid the tax going forward. Look at cash flow issues of businesses. Obviously the state will cash your check yesterday, but they'll pay the refund out, 3 months from now. So is that going to be an issue, especially as you're double paying the tax? We know a lot of S corp owners that do distributions personally to pay the estimates. But then, if the business happens to be cash strapped right now, are they going to actually be able to do the election for 2021? And then also look at distribution issues, especially in situations where if there are multiple owners and some of the owners the tax doesn't apply to, that if you're obviously impacting your bottom line, so that's going to impact the cash outflow through distributions that get made. Realize in S corps, distributions have to be pro rata. Otherwise you hurt your S corp election. Partnerships, you obviously have a little more flexibility, but even then, a discussion is going to have to be had, probably with all the stakeholders, at least at some point with all the stakeholders in play, even in situations where you might have a majority owner that's really driving this decision and they want to do it. But at least to get everybody on the same page, you're going to have to walk through this because that's something that can be impacted. Already talked about multi-state concerns. Realize that obviously if it's sourced outside the state of Michigan, it's less tax that's going to get paid. 199A, there is a pass-through deduction that basically, in the simplest form, allows you to deduct 20% of your income from your pass-through entity. Note that if you are paying an expense that is now a business expense, you are lowering that 199A deduction, which again, it doesn't eliminate the benefit. It just lessens the impact of paying the expense that I'll get into in a second. If the other thing you got to look at potentially is if owners are at different tax brackets, that's obviously going to lower the benefit for the business entity as a whole. If one owner is at the top rate of 37% and the other, say another owner is at 22%, obviously the 22% owner is not going to get, the company as a whole isn't going to get a benefit because you can't say we paid this amount for this owner, that amount for that owner. Therefore, that's where the expense goes to. You're going to have to follow your profit and loss rules in your partnership or the pro rata share in your S corp, so that the benefit actually gets spread out over multiple owners. Also understand that personal estimates may still be needed. I know some people were thinking this was going to eliminate the need for state estimates on the personal level, but understand that you can only pay the tax on the income from the flow-through entity. So that if individual owner has, dividends, interest, capital gains, other flow-through entities, Schedule C, Schedule E, all of that stuff factors in the estimate, so that there's going to have to be some management of the personal estimates. Obviously, they're going to be adjusted down since you have an entity paying the tax from the flow-through entity standpoint, but doesn't mean that your personal estimates are going to be completely eliminated. It's also something that you're going to actually have to consider are shareholder agreements, operating agreements, partnership agreements. Do your legal documents permit you or permit your entity to actually pay the tax? Obviously, these agreements can be amended if necessary, but it is potentially another step that you at least have to look at to make sure that you're covered. I obviously imagine this will be a bigger concern when you have multiple owners, but at least it's a concern that's got to be looked at. And in the end, it might not be a big deal, but you don't want to accidentally put your entity in a legal position that somebody, another owner could come back and go, hey, wait a minute, we're not supposed to be able to do, we can't do this, at least the way our operating agreement is currently written. So at least take a look at it. I kind of wrote here a generic example. Tried to keep it as simple as possible. Say that you have an S corp that's got one owner, and say they itemize their personal taxes and that they pay $12,000 of property taxes during 2021. So they've already hit the SALT limit before you even start talking about the individual income tax that gets paid to the state. In this case, the S corporation earns $700,000 of income. We're going to assume that they're not subject to any of the state adjustments. And then the individual, files a joint return. They don't have any 199A concerns, that they aren't limited by anything, and that the S corp gets the full 199A deduction, and the individual is in the top bracket, as well as all the activity of the S corp is inside the state of Michigan. So basically from there, if you take 4.25%, the state income tax rate of the amount of taxable income or business income tax base, the tax then the individual is going to be paying is $29,750. Now the S corp pays it. So the projected savings in this case is I don't want to say only $8,800, but it's $8,800, which basically is the 29,000 times the top tax bracket times 80% to show what the 199A impact is, which that number I know for a lot of people is going to be big enough to say, hey, let's do it. For some, it might not be. So it's just kind of to show something in perspective that, business earns almost $750,000 and it's an $8,800 deduction on your federal return. Now, granted, that's better than zero. And like I said, everybody's got a different threshold. So I don't want to act like it's nothing, because obviously it's something, it's a real number. But it is at least something, for all the compliance potential concerns, is this going to be worth messing around with? In the case where, say, it's a service, S corp, that it doesn't get a 199A deduction, then you would see the full impact of the 37% savings, or about $11,000. Now, again, I imagine most people would say, yes, sign me up. I want to keep the money myself, but do realize that, again, like I said, it's at least a discussion that you have. It's probably not worth the compliance cost if it's only, a couple $100 of savings or $1,000 of savings. Might not be for some people if it's $5,000 of savings. So it's just a discussion that's got to be had with your tax advisor. So basically, the bottom line here is tax planning is important, and without it, you don't want to be caught off guard. This presents an opportunity for a lot of pass-through entities, but it's not necessarily a slam dunk. So, contacting your tax advisor is going to be important, and walking through the necessary steps, what it takes, as well as all the concerns that exist. And as I've mentioned, as I've raised here, some of the concerns aren't necessarily even tax related, but it's just try to help paint a full picture. So that way, you know exactly what you are facing and what you have in front of you, so that it's not just, oh, look, I can save some money. I know for some people, it's going to be pretty easy to deal with and to work through, but for others, maybe not. And maybe, the hassle isn't worth it. I mentioned before, if the SALT limit gets raised, so now you can deduct, say, $80,000 or pick the number that's higher than 10. Now, maybe you aren't going to be limited. So if the SALT limit does get raised, are you going to want to deal with this extra compliance piece, so to speak? But again, the magic eight ball hasn't said what Congress is going to do, other than it seems likely that federal tax legislation probably isn't going to happen, at least in the near term, especially with 2022 being an election year. But again, it's just something at least to be aware of. So that's pretty much it. Kind of a quick overview of a brand new tax. We're certainly going to learn more. The state, I will mention, the state Treasury Department website does have an FAQ set up. It was actually set up on January 14th, which is where a lot of this information has come from. I did see that there was an update, a couple tweaks were made late last week, but it is a point of reference to get information as the state continues to roll this out. I did check this morning just out of curiosity if by chance forms actually do exist, and I still didn't see any. So we're kind of waiting to see on that. If you happen to have any other questions, but if you happen to think of any, I do have my contact information there. I'm pretty responsive to emails, to phone calls, so feel free to reach out to have this discussion, because this is something that we're all going to be learning here this tax season. So we want to make sure that everybody is as best prepared as they possibly can be. So do not hesitate to reach out, because we're certainly going to be happy to help. And with that, I'd like to thank you for joining us today, and wish you the best of afternoons. Thanks again, and take care.